Okay. Get this pulled up. So before we get started, I thought we'd kind of go over dates and end of semester countdown, right? It's final countdown. You're all counting down, right? So that time of year. We do just have chapter 14 left and then the group project. So just kind of to go over what we're looking at. Today, we are going to go ahead. I'm not going to lecture on chapter 14 because it's all on analysis. So we're just going to jump into the practice and I'm going to kind of explain as we go because it's really just doing analysis. So I think that will help you. So let's get back to that here in a minute. Then on Thursday, we will have a project work day. Okay, so Thursday will be a true work day. So you guys have some time to get your material together and talk as a group, you know, make sure you're all on the same page, everything. And we'll have another project day too, but just to kind of give you a heads up, that way you can get working or keep working. So that'll happen Thursday. The next week, Tuesday, we'll go over the chapter 14 exam briefly, and then you should have some time to work too. So either on chapter 14 or project, you know, whatever you need to do. So kind of building in some work time right now to get everything finalized. And then next Thursday, we're going to go ahead and test over just chapter 14. So Tuesday, your exam prep quiz and your homework will be due over chapter 14, and then we'll test on Thursday. And then the next Tuesday, the 7th of May, will also be a work day. So that'll be your final work day because the project will be due on the 9th. So you'll have like 2.5, 3 days still in class. That's why I wanted to fit one in now so you could, you know, make sure everyone's kind of doing what they need to do. So that Tuesday, May 7th, we'll kind of talk about that more when we get to it. Hopefully you'll be doing your summary and making sure your PowerPoint's ready to go and just getting everything, you know, put together nicely. And then May 9th, you'll come in and we'll do presentations. There's 3 groups, so it won't take the whole class period unless you guys each, you know, talk for 20 minutes, which I doubt. So should be good there. And then I'll kind of talk about probably Thursday. I'm going to try to have the group project evaluations done. So again, you know, part of your grade is doing a peer evaluation. So I'll have those ready for you guys too. So the project and the group evaluations will be due on Thursday, May 9th. At that point, when all of that is submitted to me, I can get those graded, hopefully that next Monday at the latest. That way you guys can determine if you want to take the final exam, which will be that next week. Okay, probably make that be like the 16th or something to give you a little bit of time. So again, the final will be optional. It'll replace your a low or a missed exam. If you do poorly on the final, if it's your lowest test grade, I throw it out, so it doesn't hurt you to take it. It will be overall 7 chapters, though, but it won't be any new questions. So you'll see questions from previous tests, basically. Okay. It will be online, so you don't have to come to class to take the final. So yeah, you can. It'll still be timed, but yeah, you'll be able to have your notes and resources. So. I think that's everything that's coming up. So just a heads up on that. Like I said, today I wanted to do chapter 14. It will help you finalize your project too. So whoever's in charge of ratio analysis will know what they're doing, right? Or what the numbers are that they're pulling. One thing I did put out for you under Unit 4, I just put it out there so it's in my office. Chapter 14 here, right under the little adaptive learning plan, you'll see a Word document, chapter 14 ratios. If you download that, it's 2 pages. I open it, I printed mine off here. So what it is a listing of all the ratios we're going to use in the chapter. So it's just, I took these from the PowerPoint because they're nice and succinct. So, you know, you can use this on your homework, on your test. I don't expect you to memorize ratios. I mean, I know some of them, you know, by heart, the ones that are easier, but some of the longer ones I have to think about. If I can't memorize them, I'm not expecting you to memorize them. That's unnecessary. You just need to understand what they're measuring and then how to use the formula. So in a minute, we're going to get into this, but basically there's different types. We have 3 different categories of ratios, and then the computations and what they're used for is all in here. So that should really help you on your Chapter 14 exam. So we'll kind of refer back to that. So as you can see, there's liquidity, which just to kind of go over, since we're not doing a full-on lecture, liquidity is just a measure of the company's ability to convert assets into cash. So we're looking at, you know, basically like current assets generally, especially, because those are the most liquid, like obviously cash checking, savings, but inventory could be sold for cash, prepaids, things like that. So those are some of the things that we're going to be looking at. And liquidity is really important to short-term creditors because they want to know that you have the reserves or the assets to cover your short-term debt. Okay, so just kind of a little bit of an overview of that. When we get into calculating this, I'll go over the stuff below it. And then solvency is more about long-term debt. Okay, so when we're looking at a company as solvent, do they have enough basically net worth to cover their long-term debt? Okay, so we're looking at our long-term creditors are finding this data important. So ability to pay, to make interest payments and repay debt at maturity. So we'll be looking at if we have the assets to cover our long-term liabilities, okay? And these are long-term assets because then if we needed to long-term cover our debt, we could sell equipment, land, things like that, okay? So that's more the big picture. And then, of course, very important, profitability, which is obviously the ability to generate earnings, to make money, then probably the most important aspect of a business, right? But being able to pay off our debt is also important. So investors, customers are important and are interested in profitability specifically. And there's lots of different ways that we'll talk about measuring that, okay? So just a few things, just wanted to cover those. So you have access to those notes. You can print them off, use them during your homework, exam, you know, project, all that fun stuff, right? Any questions on dates or anything so far? Alrighty, we'll just get right into it then. So if you open to Chapter 14, practice, let me close what I have out here. Okay. So again, there's only 3 because the last one's pretty long when we're doing the ratios. So just to kind of get you prepared there while it looks short. We'll get through as much as we can. So again, Chapter 14 is all about analysis. So it's important from a financial standpoint, not only to have financial documents, you know, income statement, balance sheet, all of retained earnings, statement of cash flow, but we need to be able to do analysis and show, are we growing? Are we losing money? You know, where are we doing better? Where are we doing worse? Where are some problem areas? So that's what we're doing in Chapter 14. And it really kind of gets into managerial accounting a little bit too, because when you're doing analysis, when you're looking at decision making. So this kind of is your bridge between financial and managerial as well. So we're getting into some analysis. So what we're looking at, there's 3 main measures that we look at or analysis. The first one is what we call vertical analysis. Excuse me. So here we are looking at percentage of, on the income statement, we're going to look at percentage of sales of each account. So vertical analysis, this is, again, this one's on an income statement. We can also do vertical analysis on a balance sheet. But all we're doing is taking each account and dividing it by total revenues to get percent of total revenues. So it kind of tells us of our total revenue, how much comes from admissions revenue, you know, and so on and so forth. Of our total revenue, how much is, you know, direct expenses, all of that. So vertical analysis just kind of lets us see percentage of revenues. If we were doing vertical analysis on the balance sheet, we would divide by total assets. Everything would be a percent of total assets. Okay. So this is where we're starting, and they're showing comparative, like we saw in the statement of cash flow. So we see previous year and current year, just to have an idea and be able. It's really important in accounting to compare one year to the next. Yeah, and that makes sense, right? We need to see our sales increasing, decreasing, costs. You know, what's happening. Okay. So here's our income statement, comparative income statement, and they want us to do vertical analysis. Well, again, it's actually pretty easy. They want us to round our percentages to 1 decimal place. So again, with vertical analysis, all we're doing on an income statement is dividing each account by total revenues. Okay. So for admissions, for example, we're taking $116,034 and dividing it by 490,160. Okay, so everything gets divided by total revenues. Okay. So what is the percent of admissions to total revenues? Anyone calculate that? And I'm going to make you work today, right? The good news is it's all just dividing, so no, you're fine. It's not tricky or complicated. Everything you're putting in is wrong.
Yeah,
are you taking? Are you putting it in as a percentage?
Man, I'm putting it in.
So like, what's your answer?
I got like 4. Well, I got 23%, like 22.
Okay, 23.7. Yeah, thank you, Ashley. That's correct. So yeah, we want to round. So when you're, I don't know how you got 4.2. Maybe flipped them.
He did the 490 over
the 116. Yeah. So yeah. So take 116,034 divided by 490,160, and you should get like 0.2367 blah blah blah. So they just want it as a percentage, rounded to 1 decimal. Okay, so it'd be 23.7. Okay. Yeah. You're welcome. It's always a rounding thing, right?
It's all just like then you just take that number and divide it by the total revenue.
Yeah, it's really that easy. It's just kind of tedious, right? So you really would. You would just go on to the next one. 151,562 divided by the 490,160, and then it's just making sure you round. So 30.9. Okay. And we don't have to do all of them. I'll give you some. You know, we don't want to spend all of our time dividing, right? But let's do one more. So NASCAR broadcasting revenue, what's its percent to total revenues?
39.3.
Perfect, 39.3%. Okay, 39.3. And then other operating revenue is going to be 6.1. 6.1. And this is. And did the same thing, took your 29,902 divided by total revenues. Yep. And then total revenues divided by total revenues is going to be 100%. Okay. Okay. So that's just the revenue portion. And if you were to add those 4 up, they would add up with rounding, considerably rounded, good, so to 100%. Okay. And then moving down, we would just keep doing the same thing. So you would take your direct expense of events divided by total revenue. And you should get 20.7. 20.7. NASCAR purse and sanction fees, you should get 25.1. 25.1. Other direct expenses, 3.9. 3.9.
Which
Which one are you doing? On the very bottom one?
Total revenues. Yeah, every time just total revenues.
So
Even on this
the
bottom
expenses?
section.
Okay.
Yeah.
Okay. I'm going all the way to the bottom.
It'll just always be total revenues. Good question. General and administrative, 37.4. 37.4. Total expenses, 87.0. So 87. And income from continuing operations, 13%. 13%. Okay, so that's all for the current year. And then if we go to the prior year, we would do the same thing. So over here on the right-hand side, only we're dividing by our new total revenues. So you would take 130, 239 divided by 506, 205. Okay, so everything on this year, the prior year, will be divided by 506, 205. And we'll pop those in. Lots of math in this chapter. 25.7 for admissions, 25.7. Event related would be 32.3, 32.3. NASCAR would be 36.7, 36.7. Other, 5.3, 5.3. Again, total revenues, 100%. Direct expense would be 21%, 21. NASCAR purse, 23.7, 23.7. Other direct, 4%, 4%. General, 47.7, 47.7. Total expenses, 96.4%, 96.4%. And income, 3.6, 3.6.
I have a question.
Sure.
For the like the column that's on the left, like the bottom left one, I don't get how you got.
So you're still just dividing everything by total revenue.
Oh, really?
Yeah, everything, your whole income statement will be divided by total revenue. Yeah. Even the expenses. Because what you're looking at here, as you can see, 87% of our total revenue is expenses. Okay, so that's kind of, we divide everything by total revenue on the income statement, which is what we're on. Okay. So, we crunch the numbers, that's important, but it's also important to kind of look at things and see what's going on, okay? If you look at last year, look at this. Our total expenses made up 96.4% of our total revenue. That's really high. That's a high expense to revenue. So of all of the revenue, our expenses were 96%. So only 3.6% is actual income that we keep. So that's pretty high. And then you could compare, see how our revenues are made up. They're pretty steady over the 2 years as far as the percent, admissions, the different types. But what we see from this period to the current year is we've decreased our total expenses by almost 10%, which has increased our income, okay? So that's something when we do vertical analysis comparatively, you can see what we've done to make changes, okay? So that's kind of the whole purpose of doing this analysis, is not only to prove to our external users, that they should lend us money or invest or whatnot, but it's also looking internally and identifying problem areas. Because last year our total expenses were a problem area. Okay. And where we made the biggest cut was here in general and administrative, and we can see that. So we ended up with a better net income in the current year just by cutting some costs, okay? So in B, and we can kind of see, it says, well, overall revenue actually decreased some between the 2 years. You know, we went from 506 to 490. So overall revenue decreased a little bit. The overall mix of revenue sources did change somewhat. For example, the NASCAR broadcasting revenue, if we compare that, it went from 36.7% to 39.3%. So we upped our broadcasting revenue. So it increased as a percent of total revenue. And admissions revenue decreased by 2%. So revenue did decrease from last year to this year. However, what's important is our net income actually increased significantly. And again, it appears that income from continuing operations has significantly improved because of cost cutting. Okay, aggressive cost cutting to be exact. So in this, you know, when we think about revenue going down but income increasing, you know, and we have to, when we look at the whole picture here, 1 year next to the other, and do this vertical analysis, we can get the why. Okay. So this whole chapter is about performance analysis and also understanding what's happening in our company. Okay. So again, these analyses can help us make better decisions to increase our profits. Okay. Any questions on that? So again, if you have one, I can't remember on the homework, if you have one where you're doing vertical analysis on a balance sheet, and you won't have total revenue. So on a balance sheet, vertical analysis, you divide everything by total assets. Okay? So, and just kind of keep that in mind or make note of it. So vertical analysis on a balance sheet, everything's divided by total assets, but it's the same concept. Okay? All right. So that's vertical analysis. The second type of analysis that we do is called horizontal analysis. Horizontal analysis is when we're looking at the change in each specific account. So we're going across, and we're looking at how did sales change from last year to this year? How did cost of goods sold change from last year to this year? And again, we're looking at it on the income statement side, but we can do horizontal analysis on the balance sheet as well. So here, we're looking at, did sales increase or decrease, and by how much? So this is another important measurement of the company, okay? So we still have those comparative income statements. Well, when you scroll down, when you're doing horizontal analysis, which, you know, you're going across now, well, what we're going to do is figure out how much it increased or decreased from last year to this year. And then we're going to show that as a percent change. Okay. Well, sales, did it increase or decrease? It increased. Good. By how much? Very good. 280,000. So from last year to this year, we see an increase in sales of 280,000. Good. Okay. So an increase in sales. To get the percent change, all you do is take that increase amount and divide it by the previous year. Okay. Get my calculator up. Where's my calculator? Okay. So for sales, I'm truly going to take 280,000 divided by 2 million. So once you calculate the amount of change, always divide that by what we call the base year, the first year, to get the percent of change. Okay. So 280,000 divided by 2 million, 0.14, or 14%. Okay. So sales saw a 14% increase. Everyone got that? All right. Cost of goods sold, we do the same. Did it increase or decrease? Increased, good. And by how much? Perfect, 210,000. 210,000. And then again, to get the percent change, you're going to take the 210,000 divided by the 1,750,000. So what percent change was that? 12, perfect. 12%. Did gross profit increase or decrease? Increase, good. And it increased what, by 70,000? 70,000. It's a pretty big increase. So what's the percent change of gross profit? 28, perfect, 28%. Okay. And then we just keep on going. So for selling expenses, those also increased, right? So it's 31,500. If we had a decrease, we would put that in as a minus or in parentheses to show that. So here we have an increase in selling expenses of 31,500, which you should get a percent increase of 25.2. 25.2. Administrative expenses also increased, and it's 22,000 by 22,000. Which is a 22% increase. 22% increase. Good old crunching numbers, right? Total operating expenses also increased. When all of our expenses increase, makes sense. It increased 53,500. 53,500. Which was a 23.8% increase. 23.8. Income before income tax increased. Well, that's good. 16,500. 16,500. That's a 66% increase. That's pretty good, right? Income tax, well, if income goes up, of course our tax liability goes up, right? The more you make, the more they take. So it went up 6,600. 6,600. Which was also a 66% increase. So it was relative to our income increase. So we stayed in the same tax percentage is what that tells me. And then my net income went up 9,900. 9,900. Also a 66% increase.
How did you get the percentage again?
Oh, so you always take the increase amount and divide by the first year. Yeah. So when I look at this with horizontal analysis, I see, my gross profit increased, all of my expenses increased too, but everything increased, at a rate high enough that my sales actually were high enough that my net income was still an increase. So this was a good year, right? The current year. I mean, we're going to see a rise in expenses when we sell more product, okay? So all of this is pretty good. We don't really see any red flags there, because a lot of these, the only one is, a lot of these expenses are tied to making that product. So the more we make, the more we sell, the more we'll see those increases. And again, as a total operating expenses increased about 24%, whereas our income increased 66%. So we still see a better income. Okay. So that is horizontal analysis on an income statement. And then just to kind of look at the trends, net income for Winthrop Company increased by 66% between years. They kind of gave you an answer there, didn't they? This increase was the combined result of an increase in sales. So sales increased. of 14%, and then a lower percentage of increase in cost of goods sold. So again, we were able to increase our sales without increasing cost of goods sold at the same rate. Maybe we upped our sales price, okay, would be a good way of looking at that. The cost of goods sold increased at a slower rate than the increase in sales. Slower rate, thus causing the percentage increase in gross profit to be greater. So again, we were able to increase our sales at a higher or greater rate than the increase in our cost of goods sold. Okay. So just kind of, again, giving you kind of some insight into analysis and looking at how we actually measure performance, okay? You could do the same thing on a balance sheet. It would be the same across. It doesn't matter. You just see different accounts, right? The assets, the current, long-term, all of that. It's just looking at a different, instead of looking at profit, you're looking more at like current and long-term debt situations, okay? Any questions? You guys good? You guys awake and alive? Barely, right? Rainy days at the end of the semester. It's like a double whammy, isn't it? Like everyone's like, oh. Okay, so this last one is a bit long, but I wanted to see what we could get done on it. I don't think you'll find this chapter too bad. You know, if you have your notes, it's really just doing the math. So my biggest suggestion on your test is just to double check your math, you know, on your questions that have math input. Because honestly, if you have the ratios in front of you, you should be able to calculate them. So most of the time it's just input error, right? I mean, I do it too. You know, it's pretty easy to type an extra zero or transpose numbers or something. So this last one, we are going to look at the ratio analysis. So, you know, horizontal and vertical give us a good overall big picture looking at income statement and balance sheet. We're going to get into more specific analysis now. So we use ratio analysis to kind of identify specific problem areas or good areas. It could be good too. So again, we're looking at liquidity, solvency, and profitability. So they give us all of our comparative financial statements, as well as the market price of common stock as of the end of the current year. So again, we see year 1 and year 2, and this is our retained earnings. And then we'll also have our income statement and our balance sheet. So everything we need. And then we need to calculate this ratio analysis. So it says determine the following measures, rounding to 1 decimal place, except dollar amounts, which should be rounded to the nearest cent. Okay. If you have a rounded answer, use a rounded answer for the requirement for any subsequent calculations. And then we're going to assume 365 days a year. Again, the good news is on your homework, you know, if you mouse over anything in green, it gives you the definition, okay, which is nice, right? So working capital, all it is, and it tells us, working capital is the excess of the current assets of a business over its current liabilities. So this is a measure of liquidity. You know, how able are we to pay our short-term liabilities? So we're going to take our current liabilities, or I'm sorry, our current assets, and subtract out our current liabilities. Okay. So we hope this is a positive number. We hope that our current assets are more than our current liabilities. Okay. Well, those both are found on the balance sheet. Okay. So the formula for working capital is truly taking current assets minus current liabilities. Well, you have that total current assets, and they did say for year 2, right? We're doing it for, yeah, for year 2. So we're doing it for the current year. The total current assets are $3,690,000, and then my current liabilities are $900,000. So I would truly take 3,690,000 minus 900,000. And that's a dollar amount, working capital. They put the dollar there for us. Okay. So our working capital for the current year is 2,790,000. So again, this is a liquidity measure. So it measures our ability to pay short-term debt. Well, we're looking pretty good if we have almost 3 million in working capital. You know, our current liabilities were only 900,000. So we have a pretty good current debt situation. Our next measure, our current ratio, is also a liquidity measurement. It's just looking at it a little different as a ratio. So we're going to take current assets divided by current liabilities. Okay. So on this one, we take current assets, which they give us the total, 3,690,000, divided by the current liabilities of 900,000. So it's 4.1. Okay, 4.1. What that means is with our assets, we could pay our current liabilities 4 times over. So the higher that number, the more liquid we are. Yes, ma'am.
When we do the test, if this is on here, is it going to have the definition?
I don't believe that the tests have the definitions, but you can use the notes that I posted. So you'll have that. Yeah. Quick ratio. Quick ratio is a little different, and so on your notes, I kind of told you what a quick asset is because the ratio is taking quick assets divided by current liabilities. Well, this is still a liquidity measurement, but it just gives us a more current, like today. If we had to pay off our current debt today, could we? Okay. So on your notes, I kind of gave you a definition of quick assets. So quick assets are always cash, plus any short-term investments, plus receivables. Okay. So we're dealing with only a few current assets here. Okay. So the quick ratio, instead of using current assets, I would take cash of 500,000 plus marketable securities are a short-term investment. Any type of investment listed under current assets is going to be a short-term investment. So I'm going to add that in, 1,010,000 plus accounts receivable. So those are my 3 quick assets: cash, short-term investments, and accounts receivable. You'll always have cash and accounts receivable. You may not always see a short-term investment. You'll just have to look for it. But as you can see, I think I talked about this, but I'm not 100% sure. On your balance sheet, your assets are always listed in order of most liquid. So, you know, it's always going to be here between cash and accounts receivable if you have a short-term investment.
So with the cash, accounts receivable, and what else?
This marketable securities, which is a short-term investment. And the reason that's liquid is if it's a short-term investment, that means it's coming mature this year, so we can cash it in.
So look in between those.
That's kind of your clue, your hint, right? When you're like, oh, is it or isn't it? So quick assets, we have what, 2,250,000. We divide that by our current liabilities of 900,000, and you get 2.5. So quick ratio is always going to be smaller because it's less. You're considering less of your current assets. You're not considering inventories and prepaids, okay? Because they're not as easy to convert to cash. So still though, we have the ability, we have 2.5 times quick assets of debt, current debt. So we can easily pay our current debt. Okay. And then we just keep going. I know there's a long list. So like I said, we'll get through what we can. I just wanted to talk about as many as we could. Accounts receivable turnover. This is also a liquidity ratio because it involves how frequently are we collecting on our accounts receivable. So, you know, of course, that's money due to us. And how quickly our customers are paying us impacts our cash situation, right? If they're not paying us within 30 days, that's holding up our cash. So this is still a liquidity ratio. And if you look at it's sales divided by average accounts receivable. So this one, we need to average accounts receivable first, okay? So we are going to take sales will be what we divide into. So where's sales? Sales is on our income statement. So sales is 10 million, okay? And then I'm going to go to my balance sheet. And what I'm going to do is find an average accounts receivable, okay? So I would truly take accounts receivable of $740,000 of this year, plus the $510,000 of accounts receivable from last year. So I add the two together, divide by 2. So average accounts receivable is 625,000. 625,000. So the ones you have to do an average on are probably the trickiest ratios. Make sure you calculate that average. Okay. Then I can take sales of 10 million divided by the 625,000. And you should get 16. 16. So on average, they're saying we collect on accounts receivable like 16 times a year. Okay. So again, the higher that number, the better it is. The next one, we're looking at how long, the number of days sales in receivables, the number of days sales. So how long does it take for someone to actually pay their accounts receivable? So you notice we're still using the average accounts receivable, okay? So we're still going to use the 625,000 that we just calculated, but now we're dividing by average daily sales. So we have to calculate that. It's fun, right? Lots of calculations. Again, I did put that on your notes down at the bottom here. Average daily sales is just sales divided by 365 days, okay? So if sales was, got to pull my calculator back down. There we go. Sales was 10 million, right? Divided by 365 days. That'd be 27,397.3. Oh. Okay. And so I'm going to take my average accounts receivable, which I previously calculated at 625,000. Divided by my average daily sales of 27,397.3. And we should get 22.8. 22.8. Okay. So that one we have to do 2 averages before we can calculate the ratio. Again, it's still a liquidity ratio. It means on average, it takes our customers about 23 days to pay their bill. Well, if we had a net 30 invoice, that's pretty good average, right? I mean, we're still hitting that goal. So that's not bad. If we had a net 15 policy, they're all paying late, right? So again, you know, it depends on, some of this we have to understand how the company operates to really evaluate the efficiency. And sometimes it's an industry specific thing. Again, it's just kind of good for you to kind of start understanding it. I'm not going to ask that you tell me all the ratios and what they mean. But again, on your group project, you will want to highlight some of these. So it kind of helps you see why these are important. So if you were able to find your company's accounts receivable terms, net 15, net 30, and calculate that, you could say whether they're, you know, efficient in collecting their debt. Does that make sense? So it's just kind of learning a little bit more critical thinking on the financial statements. Okay. And then we just keep going, I know, right? The next one is inventory turnover. So how often are we actually selling, you know, what's in inventory, turning it over, okay? So you take cost of goods sold and divide it by average inventory, okay? So again, we have to find an average inventory. Okay, so here I would look at my inventories. So I would need to average those first. So 1190000 plus 950,000 divided by 2. My average inventory is 1,070,000. Yeah, that's right. 1,070,000. Okay. And we're just going to take cost of goods sold and divide it by that. Well, where would I find cost of goods sold? What statement? It's in the same statement as expenses. What main statement would you see cost of goods sold on? Yeah, great. The income statement. Good. I'm trying to keep y'all awake by making you answer right. So cost of goods sold is 5,350,000, and we are going to divide that by our average inventory of 1,070,000. And we should get an even 5. So on average, we turn over our full inventory about 5 times a year. And again, we would have to know our industry and our company to know if that was a good or a bad measurement there. We also want to do number of days sales in inventory. So what that tells us is how long on average is something sitting in inventory before it gets sold. Okay, so there, that formula, we are going to take our average inventory, which we've calculated, divided by our average daily cost of goods sold. So just like our average daily sales, to get that, we're going to take our cost of goods sold divided by 365. So 14,657.5. Because they said to round to 1 decimal. So that's our average daily cost of goods sold. Average inventory was 1,070,000 divided by the average daily cost of goods sold we just calculated, and you should get 73 days. 73 days. So those were all liquidity ratios. So we're looking at our efficiency in using current assets. Okay. And the next group of ratios is dealing with solvency. So we're looking at our ability to pay our long-term debt. Okay. And again, we'll get through what we can. I just wanted to go over most of them. The next one, number 8, is ratio of fixed assets to long-term liabilities. Well, as you can imagine, all we're going to do there is actually divide fixed assets by long-term liabilities. Okay, so on my balance sheet, what are fixed assets? What would be another term for fixed assets? Current assets are different. What are fixed assets? What's some examples?
Property, plant, and equipment.
Very good. Property, plant, and equipment. Your fixed assets are things you have more than just their current year. So they're also long-term assets. So land, equipment, buildings, anything like that. So it's a fixed assets. That will be your property, plant, and equipment. Okay. So another word, remember, we have like 5 terms for things, right? So long-term assets, fixed assets, property, plant, and equipment, all the same thing. So 3,740,000, and we are going to divide by our long-term liabilities, which they give us here, 1,700,000. So 2.2. So our fixed assets are 2.2 times that of our long-term liabilities. So we're in a pretty good position to pay our long-term debt. We have more fixed assets than we do long-term debt, 2.2 times, okay? So what that tells, long-term creditors are the ones that are interested in solvency, because if we ask to borrow more money, they would want to know that we had the assets to cover it. You know, if we went bankrupt, you know, we would have to liquidate our assets and we'd be able to pay them if something went wrong. Okay. And the next one is ratio of liabilities to stockholders' equity. Okay. So here it's looking at how much of our company is financed by debts versus equity, okay? Which is kind of important too, right? If our whole company is financed on debt, it's kind of scary. Whereas equity would be more common stock, bonds, you know, things of that nature, okay? So we are going to take total liabilities divided by total stockholders' equity. Total liabilities, 2,600,000. I have enough zeros? No. Yes. Okay. Divided by total stockholders' equity of 7,180,000. Okay. And I get 0.362, so that's going to round to 0.4. 0.4. So long-term liabilities make up 0.4, 40% of our total stockholders' equity. Okay. Y'all having fun yet? No. But is it better than bonds? Calculating discounts and amortizing. Right? You know, it's like you got to look at it from the positive side of things. It's tedious, but it's just crunching numbers. So you don't have to know how to amortize a bond ever again unless you go into finance. And then there's Excel spreadsheets to do it for you. Let me see out of the remaining ones if there's any that are kind of tricky, because I think you can pretty much follow, right, the formulas and everything. So I don't want to sit here and just like blah, 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 blah. My throat hurts. Y'all don't care. And damn allergies, right? It's like, I woke up yesterday and I'm like, oh, I feel like everyone's kind of just, it's, yeah. So, you know, I get it. So I'm just going to look at them, see if there's any that are like tricky. Times interest earned, is it still solvency? They give you the formula. It's really straightforward. I don't think you'll have any problems with that. And then your profitability ratios. When you're doing this long one on the homework, just make sure when you calculate like average assets or average inventory, write those numbers down on scrap paper because you'll use them again. Okay, so just make sure of that, because like when you get to asset turnover, well, that one's total average total assets, but it seems like you do use them again in the top part. So just make sure you do that. You'll use average total assets twice, so make sure anytime you do an average, just jot it down. And again, an average is just 2 years added together divided by 2. Just make sure you do that first. I think the biggest part where people get off on ratios is going back to math order of operations, you know, like if you type it into your calculator wrong. So just be careful with that. What I mean is, like, I'm sure, I know there's different ways to know about the order of operations as far as what your calculator will calculate first and what you're supposed to calculate first. I always learn, like, please excuse my dear Aunt Sally. Did y'all learn that one? Okay. So, you know, anything in parentheses will get calculated first, and then it's exponents, then it's multiplication and division, then adding and subtracting. So if you don't put things into your calculator right, you might come up with wrong numbers. What I mean is, ultimately, calculate your averages first and then do your division. You know, get the average first, like what we did. Otherwise, if you take sales and do a divide, you'll be dividing by the first number you type in. So be careful with that. I think most of these, again, profitability, you're looking at if you're able to generate earnings. So you're looking at how efficiently we use assets and investments, basically. I think asset turnover, return on total assets are fine, return on equity. Return on common stockholders' equity, is that one on here? Yeah, it is. That one may be just slightly tricky because notice you're taking net income minus preferred dividends and dividing it by average common stockholders' equity. So that one's a little tricky. There's your dividends up here. So just make sure on your stockholders' equity section, on common, when you're doing average common stockholders' equity, you're only taking common stock. Okay. So some of those, I think when you get into the ones dealing with equity and shares and stuff, just be careful and read them because they don't want your total stock, just the common stock there. You will use shares of common stock outstanding. Let's see if they give that to you anywhere. So you'll have to calculate that. I think that's the only other tricky one. Is calculating, make sure your shares of common stock outstanding. So you would actually have to calculate. You take your total stock divided by the par to get how many shares were outstanding. Anything else? Market price per share. I think they give you the rest. Just making sure here. I know there's a lot of information, right? They give you the market price up at the top. So just make sure on those last few ratios, when it's referring to the market price per share, it's not in any of the statements. It's just listed at the very top. Okay. So just some common pitfalls there. I think that's it. Per share. Any questions on any of it? Okay. Again, the test won't cover every ratio, okay? You won't be doing some of the trickier stock ratios because I don't see the point. But we'll talk about which ratios to review. And again, these notes are out on Canvas. It's just called Chapter 14 Ratios. So print those off and you can use them homework, exam, everything, okay? So we'll talk about that more before we test next Thursday. We'll go over which ratios to kind of really pay attention to.
You think that thing knows like who's talking?
Oh, I do. Well, it's my account. I'm recording it.
Oh.
So it's using Zoom. So sometimes I try to record like if people are missing and then they can have the lecture. So, It's my account, so it knows. If we were all logged in, it would show who was talking based on your account. Yeah. It's pretty cool because you can have like live meetings or you can like, I just use it to record really, but like, or even like I've used it, like I've told students, you know, maybe it's an online class and I can't meet face to face, but I could Zoom live with them and they can see what's on my computer. Yeah, it's really pretty handy.
Where are you recording it?
Yeah, it's actually